So in our previous episode, we spoke a little bit about risk management. I give you guys 3 tactics or 3 areas to focus on when it comes to risk management. In today's episode, we're going to dig a little bit deeper into the portfolioization. So understanding, what pairs are correlated and understanding maybe how to put yourself in the safest position so you don't have too much exposure to the market. Curiosity, why is it that those specific pairs tend to correlate with euro yen, pound yen, dollar yen don't correlate well? Is there a specific reason based on the past experience? Just because they're majors. So the yen is a major pair, the pound is a major pair, the euro is a major pair. So when you have stuff like Aussie, Canada, and New Zealand, those are all minor pairs. So they will tend to follow. Those are small chickens following big hens. Right? They don't tend to kind of have the same pull that the dollar does. The dollar and the yen are 2 behemoths, right? The 2 safe havens doing battle. The euro is a strong pair. The pound is a strong pair. So it's more strength versus strength. And when I say strong, I don't mean like necessarily strong directionally, but strong meaning like there's a lot of volatility, there's a lot of interest in those pairs. Does that make sense, guys? It's like you're not trading the Mexican peso. Like there's not a lot of interest in the Mexican peso, right? But there's a lot of interest in the pound. So what you do is you see more kind of natural moves, right? The Aussie yen, the Canada yen, the New Zealand yen, pretty much those pairs are gonna, like, the yen is so much bigger than those pairs that if there's an overall underlying bias in the yen, so like let's say there's yen strength, right? If there's yen strength is probably going to win out against the Aussie, the New Zealand, the Canada, the Swiss, right? It's going to win out against all of those because the yen is that much powerful. If there's yen strength, it may not win out the same way against the dollar because there's a lot of opinions that are based off dollar movement as well. Or there's a lot of opinions based off pound movement and euro movement as well. Right? So that's why you see a lot of dollar crosses as well, where like the euro dollar is its own kind of thing. The pound dollar is its own kind of thing. The only one that has probably a correlation, I would say, is Aussie dollar and New Zealand dollar. Those are, Aussie and New Zealand are both very similar, and they're both smaller pairs. There's a risk on, risk off factor with those as well. And they both do well in testing for me. That's why I keep them both. But there's a lot of versatility in my portfolio, even though it's not that many actual pairs. So I hope that makes sense. But yeah, that's another very good question. Yeah. So so it's not a bad idea to trade a lot of yen pairs, but just make sure you're trading some of the behemoths, the big ones, right? You start trading the small ones, they all tend to do the same thing, which is good if they're going well, but if they're losing, it's bad. And remember, conservation of capital is the goal. So I would rather, I will pass on a 60% return if it means taking a 40% drawdown to get that return. That was another lesson I learned early on in my money management career. I used to brag about, like, hey, I can get you 60% return. Well, what's the drawdown? Well. Drawdown, about that drawdown. Well, 40%. What was that? 40%. No. Oh, damn it. But that was my mindset. My mindset was I didn't think about, I didn't understand that I've never been a wealthy person. Wealthy people don't really care about their returns. They care about the risk. Like, they already got their wealth, right? Wealthy people don't care about you making 100%. They don't want to lose what they already have, right? Same thing going back to the risk management. So I thought, when I set up my pitch, I'd go in there and I'd fix the money management spreadsheet to maximize profits. And I go, if I can tell this guy I can make him 80% in a year, of course he'll give me his business. But the more aggressive you are with your money management strategy, the bigger drawdowns you take as well. So I do stuff where I'd crank out. Like if I took my last years of trading, I did this over the winter. If I take last year's trading results and I get really aggressive with my money management strategy, I could have had a 220% return. I'm not lying. You heard me right. 220%. 220% return, right? But I would have had to take a 50% drawdown. because I had a rough stretch. And that rough stretch in reality was like 9% drawdown in real life. But when you're getting aggressive with that money management and that position size is bouncing all over the place, basically it got multiplied by like 5. So the question is, at this point in my trading, do I want to take a 50% drawdown? Hell no. Hell no. Hell no. Can I say it again for the people in the back? Hell no. Not worth it. Not worth it. Because you get the 50%, you're in blow your account territory. You're in blow your account territory. And if you blow your account, you're done. You can't make any money. So I'd rather have a much smaller, consistent return with limited risk than the big one. But that was a lesson learned too. And it was a really valuable lesson, and one that helped me now, because it's so easy to have a larger trading account and start going bonkers with it, and then all it takes is one mistake or a stretch of mistakes, and then you're done. You're out the game. And you see it's sad. You see that happen to traders all the time, where they have good like 5-year stretches, and then you never hear from them again, and they're out the game because they got greedy and they blew it all. Right? It's like gamblers that go to the casino. I used to do this in casino all the time, craps table. Used to make a lot of money in craps table, and then I stay for another hour and I'm broke. And I'm like, why didn't I just leave while I was ahead? Well, because I was so hot and I was feeling it. I thought I couldn't be stopped. I thought I was doing something different. Where in reality, it's your numbers, man. Your numbers are what they are. Don't, whatever. But anyway, some good lessons that I learned. So if you love the episode and you want to hear more about building a trading portfolio and specifically what I looked for when I built mine, go back and listen to episode 960. It's titled How I Built My Trading Portfolio, as we dive a little bit deeper into that topic. As always, thank you guys for joining. Thank you guys for supporting. Thank you for helping to turn this show into one of the most highly rated trading podcasts out there. Love the direction we're going on. Keep spreading the word. We'll keep growing the show, and we'll keep banging out great episodes.